I'm Owen Bigland. This is the Inside Edge video blog. Well, as expected, and as I was warning people this past summer, Ottawa just announced yet another mortgage tightening, new wave of mortgage tightening requirements here. This is now the 7th mortgage tightening or change that has been done since 2008. So they continue to. They started with Dixie cups of cold water that they were throwing on the market starting back 5-6 years ago, and now they've moved themselves up to I think 10-gallon drums here of cold water that they're throwing on this market to try and cool it. Hasn't done much yet so far. This one, however, might have a little bit bigger impact. So the latest one now is earlier this year they announced that for insured mortgages or high ratio mortgages, you would have to qualify at the Bank of Canada benchmark rate or the contractual rate plus 2%. That was the stress test. So it cut down affordability by about 15 or 20% for insured mortgages. Well, the latest one that just came out this week is now affecting uninsured mortgages, or what we call conventional mortgages. So that are people that are putting 20% or more down on the purchase of the house. Again, they will have to qualify for it at the benchmark rate or the greater of the benchmark rate, posted rate, or the contractual rate plus 2%. So in a nutshell, this is going to lower the purchasing power by anywhere from 15 to 20% for the typical buyer. So what effect this will have on the market, we'll have to see. These will come into effect January 1st, 2018. So, my take on it, I can totally understand when the government put these stress tests on high ratio borrowers, because if you're only putting 5 or 10 or 15% down, there's a lot of risk there. They want to make sure that that buyer can withstand the inevitable interest rate hikes that are going to be coming. We've already had 2 quarter-point ones, and we're going to probably get some more next year. But this one now is on uninsured mortgages, conventional mortgages, where they're putting 20, 25, 30% down, which in my opinion is a little bit overkill, to be perfectly honest. But it goes back to the blog I did earlier, late summer of this year, talking about cheap money but not easy money. And I blogged about how Canada has some of the toughest borrowing requirements of any country that I know of. If somebody knows of a country that has a tougher requirements to get a mortgage, I'd sure like to see it. Canada by far is the most conservative. So a lot of people have emailed me here, commented on my Twitter page and YouTube, wanting to know, well, if it's going to affect purchasing power by 15 or 20%, is it going to affect the prices by the same amount, 15 or 20%? I don't think it will. Time will tell. I have no idea, to be perfectly honest. We have to see with these brakes that they keep putting on this market. Now, it's going to be introduced January 1st. January, February are 2 of the slowest months for real estate. I generally go away for Christmas and don't come back until the 1st or 2nd week in January. I might extend my trip this year, who knows? So I think it will have an effect on sales volume. Detached, of course, is already way off, but it could put a damper on condo sales. Inventory is still ultra low, nothing has changed there, but this will affect the affordability for people. Thus, it should have some effect on the volume and the number of sales. So, what I might predict is January and February are going to be slower months for condo sales, but we'll see what it'll do for the prices. Time will tell. Generally what happens, just like with the foreign buyers tax that came in, sales tend to drop, prices kind of tread water, maybe go down a little bit. After a year, people forget about it and off they go again to the races. That's what happened with the foreign buyers tax on condos. Lasted about 6 months where it treaded water, and then it's been off to the races ever since. So only time will tell here. One final thing that'll just kind of go off topic here, though, getting back to how tough it is to get a mortgage in Canada, and now with this new stress test on uninsured mortgages. I recently had a case here where I sold a detached house that was AG1, agricultural. I sold in August at about $2 million. I ended up having a buyer on this who is a self-employed landscaper. Very successful guy, had been in the landscaping business for about 20 years, but was self-employed. He was telling me that his bank, was with one of the big 5 Canadian banks. He had to end up putting 40% down on this property. Part of it was because it was AG1, which has always got a little bit stricter borrowing requirements. But the other thing, of course, is he was self-employed. And it is getting more and more difficult if you're self-employed in Canada to get mortgage qualification as well. They want a lot more skin in the game, a lot bigger deposits, down payments, and a lot more scrutiny on your income. And, you know, I think this latest mortgage tightening, what this is really going to affect is a lot of younger people, first-time buyers, the ones that Ottawa claims that they really want to start getting a helping hand to get into this market. This is probably who it's going to affect more. You know, the fat cat investors who own lots of properties, have the wherewithal and the capital, will be able to continue to buy unabated, whether they need a stress test or not. But this is really going to have a big impact on younger people trying to get their foot in the door in this market. I can understand wanting to stress test these mortgages, especially on high ratio. But when you're starting to dabble now in conventional mortgages, and as I say, most self-employed people are putting down 25 and 30% anyways. Most of the mortgages I'm seeing now on townhomes or detached homes are all conventional mortgages. I blogged about it in the past. The 5% down is long gone. You're never going to get 5% down. Doesn't matter who you are, pretty much. Even with high ratio, you're putting down 15% generally now. But I'm seeing more and more conventional mortgages. And, you know, there is so little risk to the banks on these things to stress test them, in my opinion. You know, you buy $1 million house, and you have to put conventional mortgage on $1 million property. But most people are putting $250,000, $300,000 down on these purchases. So let's say they buy it today and the market drops 10% or 15% 5 years from now. There's still absolutely no risk to the banks here. The guy's put $250,000 down when he bought it. In the last 5 years, he's chipped off another $100,000 off that principal easily. So he's now got $350,000 or $400,000 of equity in that property after 5 years. If the market goes down 30%, which would be a pretty catastrophic correction, the bank still has no worries. The guy is still above water by $100,000 or $150,000 on this house. And now to have to stress test that another 2%, in my opinion, it's a bit of overkill. But we'll see where this goes. I will do more blogs on this after the new year. It's way too early to see what impact this will have. I think it will have an impact. It's got to. If you're going to affect the purchasing power of the buyer by 15 or 20% with this new stress test, eventually it will have an effect on the market and the prices. And it will definitely have an impact on the sales volume. That will come first. Where it'll go from there, let's find out. I'll do more blogs on this after the new year, after it's been implemented, and see where it goes. I'm Owen Bigland. Thanks for watching. I'll see you next week.